Good morning, everyone, and welcome to a new episode of Merrill's Monday Market Madness. Today, we are going to be taking a look at the Phoenix housing market. What are the trends? You probably heard the inventory is rising, prices are falling. I want to share with you the actual numbers and the actual data so that if you're a buyer or a seller or thinking about being a buyer or a seller, you can make an informed decision. And in a minute, I'll be sharing my screen and sharing some slides and some helpful information. But if you're, in a specific situation and you really want a better breakdown of what the market's doing in your part of town, or you want an update regarding, what the value of your house is, or you have a specific situation and you'd like to see some data around it, I am always more than happy to chat with you about that and help in any way that I can. I like to start every episode by looking at what we call our month's supply of inventory. So active on the market, we have 19,575 listings right now. There are 8,516 homes that are pending or under contract, and 5,622 homes that have closed in the past 30 days. So the month supply of inventory number, we just take the active divided by the number of homes that have sold over the past 30 days. And we're coming up right now with a number of 3.48, 3.5 months supply of inventory, which is pretty consistent with where it's been lately in the kind of mid threes. It hasn't really been climbing too dramatically, maybe slightly. In fact, I'm going to go ahead and share my screen with you now and show you what this looks like. So let's see, share my screen here. All right. So I graph, I put down onto a chart basically every day how many, what the month supply of inventory is on that particular day. That's reflected on this chart here on the left. Zoom in on that a little bit to make it a little bit bigger. So as you can see, we were at a low of around 0.5 month supply of inventory around April 1st. And then since that time, it has just absolutely skyrocketed until it hit these kind of low to mid 3 range. And now it's just kind of been camping out right here. So it's not really continuing to climb. And then the other thing that's interesting is we also chart on our graph how many active listings there are. So this blue line is our actives. So as you can see, we were at a low of around April 1st. We had around 4,500, in fact, one point more like 4,200 active listings. And now we're almost at 20,000 active listings. You can see it was climbing very dramatically from April 1st. But then around mid-July, maybe August, it really stopped climbing so dramatically. It is still climbing slightly, but not too bad. And we're really seeing the same thing with the pendings. Like it just really leveled out right here. The closed really leveled out right there. So kind of based on what I'm seeing from all those charts, it definitely looks like the market, without a doubt, right? It slowed down. Inventory climbed dramatically. But now everything's kind of reaching a balance. Inventory is not skyrocketing like it was. Prices aren't really falling like they were. Let me show you a couple other charts. So this is put out by a company called the Cromford Report. They publish a bunch of data for the real estate in the Phoenix area. And this is what's called their market index. People look at this chart and they want to think it's prices. It's not prices. This number that you see over here is a market index that measures how hot the market is. A perfectly balanced market, one that doesn't favor buyers or sellers, according to the Cromford Index, would be a 100. And as you can see, we were at a high point this year of about 474. And then again, right around April 1st, it really, really took a nosedive. But then right around August, it really leveled out. Each one of these dots is a new week. So as you can see, last week we were at 105.5, and then today we're at 105.2. So very, very balanced market according to the Cromford Index, and not really falling anywhere near the rate that it was falling before. This is a graph of how many listings in our MLS are adjusting their price or doing price reductions. And, obviously it goes way back to 2013. Each bar is a new week. And again, almost nothing was having price reductions in January and February. March started to see a few more. And then right around April, mid-April and early May, we started to see a lot. We had a high number of price reductions the week of July 24th at 4,172. Last week, we saw 4,097. So you can see not a huge increase in the number of homes that are reducing prices over the last 2 or 3 months as well. It's also kind of still a lot of homes reducing their prices. But again, there's almost 20,000 active listings, 4,000 reduced their price. So roughly a fifth of all the homes that are on the market are doing price reductions right now. Now, another thing that's been coming up a lot lately, because I do work with some investors, and advise some investors as well, and people just kind of come to me to get, thoughts and opinions, and hey, what should this house be renting out for, and that kind of thing. This is a look at the average price per foot for rental properties in our MLS. And as you can see, it's just been climbing super steadily, right? The average price per foot back in 2015 was 73 cents. And then in August of 2021, it hit $1.37. And in September of 2022, it's at $1.36. So basically over the past year, we have basically seen no change. You've seen some tiny little ups and downs, right? By a few cents per foot, depending on what homes closed that month. But statistically speaking, I guess August of 2022 saw $1.40, which was our highest price per foot. But really, this is also really leveling out. We're not seeing massive increases in the average rents in the Phoenix market right now. In fact, rents in some areas have even fallen a little bit. A lot of that has to do with how many investors and hedge funds have bought up a ton of rental properties, and now there's just a lot, just like regular for sale homes, there's a lot more homes available to rent right now as well. Now, I think the biggest question mark regarding the market is going to be surrounding mortgage interest rates, right? The market really started to slow down when mortgage rates went crazy, because it really has a negative impact on affordability. It makes it hard to afford when rates are only at 3%, you can afford a lot more house than you can when rates are at 6%. So right now, with rates being at, that's not the window I wanted to click on. We hit an all-time high, well, not an all-time high, but the highest rates we've seen since 2008. 30-year fixed rate mortgages hit a rate of 6.02%, according to Freddie Mac last week. And here you can kind of see this blue line on top is where rates have been at on a 30-year fixed rate term. So rates aren't great right now, and that's going to continue to put pressure on the market for prices to possibly come down a little bit farther. But at the flip side of that coin, as I've just shown you on a bunch of charts and graphs, is that the market has really leveled out. And even in the high 5 rates that we've been at, inventory is leveling out, and the market index is leveling out, and price reductions are leveling out, and rental prices are leveling out. So, I don't know. We'll see what happens with the Fed and what they do with inflation and all that. Of course, a million factors that are going to have an impact on mortgage interest rates. But all the indicators are that the market's really leveling out right now. If rates improve, I would expect the market to pick up. If rates get worse, I would expect the market might see a little bit more of a dip. And so that's kind of where we're at right now. And a very important thing, I've tried to, I've talked about this before. So if you've seen this before, and I'm going to stop my screen share here so you don't get the weird window. I've tried to talk about this before, and it's a little complex I think I'm just really bad at explaining it. But basically, everyone's already heard, okay, the inflation numbers came out bad. Next time the Fed meets, they're going to probably raise rates, and they're talking about raising it as much as an entire percentage point or 100 basis points. And so people assume, okay, well, once that happens, mortgage rates will go up by 1%. And it's actually kind of opposite to that. So mortgage rates react in advance of what the Fed does, based purely on speculation, just like stocks do, right? If you hear that a company might have really good news, or they've got an awesome new product, or they, whatever, then the speculation is the value of their stock is going to go up. So people buy it ahead of time, right? or if the speculation is that a stock is going to go down, people will dump it ahead of time before the event actually occurs. Well, mortgage rates do the same thing. So the 6% rate that we're seeing right now is basically, in my opinion, it's already reflective of the fact that the Fed intends to raise rates by 100 basis points. If the Fed ends up doing less than that, let's say they decide, you know what, that's too much, we're only going to do 50 or 75 points, then it would probably cause mortgage rates to dip slightly. So all things to keep an eye on. And that's where we're at on the market right now. I hope you found this information helpful. Let me know if you have any questions. Have a great day.